20. Commercial real estate terms. You must know. Understanding key commercial real estate terms is essential for anyone involved in the industry, whether you're an investor, broker, or business owner. These terms form the foundation for navigating transactions, leases, property management, and investment strategies effectively. Familiarity with concepts like net operating income, NOI, cap rate, and tenant improvement allowance can significantly impact decision-making and financial outcomes. This guide highlights 20 essential terms every professional should know, offering clear definitions and practical insights. Whether you're new to commercial real estate or looking to deepen your knowledge, mastering these terms will enhance your confidence and success in the field. 1. Net operating income, NOI. NOI represents a property's profitability by calculating income generated after operating expenses but before taxes and financing costs. It's calculated by subtracting operating expenses, like maintenance, utilities, and property management fees, from gross rental income. NOI is crucial for investors as it determines a property's financial performance and valuation. A higher NOI often indicates a more profitable investment. Understanding NOI helps in comparing different properties and assessing their potential return on investment, ROI. It's also integral to calculating other metrics, such as the cap rate, which measures a property's investment potential. 2. Cap rate, capitalization rate. The cap rate measures a property's potential return on investment, expressed as a percentage. It's calculated by dividing the net operating income by the property's market value or purchase price. For example, a property with a net operating income of $100,000 and a purchase price of $1,000 has a cap rate of 10%. A higher cap rate often indicates higher risk and reward, while a lower cap rate suggests stability but potentially lower returns. Investors use cap rates to evaluate and compare properties, helping them identify which assets align with their risk tolerance and investment goals. 3. Gross lease. A gross lease is an agreement where the tenant pays a fixed rent and the landlord covers most operating expenses, such as property taxes, insurance, and maintenance. This lease type simplifies budgeting for tenants, as there are no additional costs beyond rent. Gross leases are common in office and retail spaces, benefiting businesses seeking predictable costs. However, landlords may adjust the rent to account for rising expenses. Understanding gross leases is crucial when evaluating commercial lease agreements, ensuring clarity on responsibilities and costs, and comparing them with other lease types like net leases. 4. Net lease. A net lease requires the tenant to pay a base rent plus some or all operating expenses, such as property taxes, insurance, and maintenance. There are 3 main types: single net, N, double net, NN, and triple net, NNN leases. In a triple net lease, tenants assume most property-related costs, providing landlords with stable income. This arrangement is common in retail properties and long-term leases with national tenants. Net leases appeal to investors seeking passive income and to tenants desiring control over property expenses. Clear communication is essential to define responsibilities in these agreements. 5. Tenant improvement, TI. Allowance. A tenant improvement allowance is a sum provided by landlords to help tenants customize or renovate leased spaces to suit their needs. Common in office and retail leases, TIs cover costs like painting, flooring, and partition walls. The allowance is negotiated in the lease agreement, either as a fixed dollar amount or a cost per square foot figure. TIs benefit tenants by reducing upfront costs and landlords by attracting quality tenants. Understanding TIs helps both parties plan effectively and ensures the property aligns with business operations while maintaining market appeal. 6. Build-out. A build-out refers to customizing a commercial space to meet a tenant's specific needs. This process often includes structural changes, electrical work, plumbing, and aesthetic upgrades such as flooring and paint. Build-outs are typically part of lease negotiations, with landlords offering a tenant improvement allowance to cover some or all costs. The scope and responsibility for the build-out should be clearly outlined in the lease agreement. Understanding build-outs ensures tenants can create functional spaces for their businesses while landlords maintain the property's value and marketability. 7. Cash flow. Cash flow is the net amount of money moving in and out of a property investment over a specific period. It's calculated by subtracting operating expenses and financing costs, like loan payments, from total rental income. Positive cash flow indicates the property is generating profit, while negative cash flow means expenses exceed income. Cash flow is a key metric for evaluating investment performance, as it affects both short-term profitability and long-term financial stability. Strong cash flow ensures an investor can cover debts, reinvest in property improvements, and build wealth. 8. Vacancy rate. The vacancy rate is the percentage of unoccupied rental units in a property or market over a given period. It's calculated by dividing the number of vacant units by the total units, then multiplying by 100. For example, a building with 10 units, 2 of which are empty, has a vacancy rate of 20%. High vacancy rates may indicate poor property management or market oversaturation, while low rates suggest strong demand. Investors monitor vacancy rates to assess property performance, forecast income, and identify trends in supply and demand within a specific area. 9. Common area maintenance, CAM charges. CAM charges are fees tenants pay to cover shared property expenses, such as maintenance of lobbies, parking lots, landscaping, and lighting. These costs are typically divided among tenants based on their leased square footage. CAM charges are common in retail and office spaces under net leases. Clear communication about CAM charges in lease agreements is essential to avoid disputes. Tenants benefit from well-maintained common areas that enhance customer experience, while landlords recover expenses for upkeep, preserving the property's functionality and appearance. 10. Fair market value, FMV. Fair market value is the estimated price a property would sell for in a competitive market, where both buyer and seller are informed and willing participants. FMV is influenced by factors such as location, condition, comparable sales, and market trends. It's critical for setting lease rates, buying or selling properties, and securing financing. Accurate FMV assessments ensure fair transactions and help investors determine if a property aligns with their financial goals. Engaging professional appraisers or conducting thorough market analysis can provide reliable FMV estimates. 11. Lease term. The lease term refers to the duration of a rental agreement between a landlord and tenant. Typically expressed in months or years, it defines the start and end dates of the lease period. Longer lease terms often provide stability for both parties, with tenants securing predictable rental rates and landlords ensuring consistent occupancy. However, shorter terms offer flexibility, especially in changing markets. Understanding the lease term is crucial for budgeting, future planning, and negotiating renewal options or early termination clauses that align with business needs. 12. Zoning. Zoning regulations designate how specific land areas can be used, such as for residential, commercial, industrial, or mixed-use purposes. These rules, established by local governments, ensure organized development and prevent conflicting land uses. For example, commercial zoning may allow for retail stores, offices, and restaurants, but restrict industrial activities. Understanding zoning is essential when purchasing or leasing property to ensure compliance and avoid costly legal issues. Investors and tenants should also explore rezoning possibilities or variances if a property's current zoning doesn't meet their intended use. 13. Pro forma. A pro forma is a financial projection used to evaluate a property's potential profitability. It includes estimated income, expenses, and cash flow over a defined period, often assuming optimal conditions. Pro formas help investors assess a property's viability before purchase, compare investment opportunities, and plan long-term strategies. However, they are based on assumptions which can be overly optimistic or conservative. Reviewing and validating pro formas with actual market data, such as historical performance and current trends, is critical for making informed investment decisions. 14. Absorption rate. The absorption rate measures how quickly available commercial properties are leased or sold within a specific market over a given time frame. It's calculated by dividing the total square footage leased or sold during a period by the total available inventory. A high absorption rate indicates strong demand, while a low rate suggests market oversupply. Monitoring absorption rates helps landlords, brokers, and investors identify market trends, adjust pricing strategies, and anticipate changes in property values or vacancy levels. It's a key indicator of market health and competitiveness. 15. Debt Service Coverage Ratio, DSCR. DSCR evaluates a property's ability to cover its debt obligations using its net operating income, NOI. It's calculated by dividing NOI by total debt service, loan principal and interest payments. A DSCR above 1 indicates the property generates sufficient income to cover its debts, while a ratio below 1 suggests insufficient income. Lenders often use DSCR to assess the risk of providing financing for a property. A higher DSCR demonstrates financial stability and increases the likelihood of loan approval, making it a critical metric for property owners and investors. 16. Letter of Intent, LOI. A letter of intent, LOI, is a preliminary document outlining the key terms and conditions of a potential commercial real estate transaction. While non-binding, an LOI demonstrates serious interest and establishes a framework for further negotiations. It typically includes details such as the property description, proposed purchase price or lease terms, contingencies, and timelines. The LOI streamlines the negotiation process by identifying potential deal breakers early. Both parties benefit from a clear understanding of expectations before drafting legally binding contracts, reducing the likelihood of misunderstandings. 17. Return on Investment, ROI. Return on Investment, ROI, measures the profitability of a commercial real estate investment, expressed as a percentage. It's calculated by dividing the net profit by the initial investment cost. For example, if an investor earns $50,000 on a $500,000 property, the ROI is 10%. ROI helps compare the performance of different properties and assess whether an investment meets financial goals. Factors like cash flow, appreciation, and operating expenses impact ROI. Understanding this metric ensures informed decision-making and allows investors to balance risk and reward effectively. 18. Sale-leaseback. A sale-leaseback occurs when a property owner sells their asset to an investor and simultaneously leases it back. This arrangement provides the seller with immediate capital while retaining operational control of the property. It's commonly used by businesses seeking to unlock equity without relocating. For investors, sale-leasebacks offer stable, long-term tenants and predictable income. Both parties benefit from clearly defined lease terms and mutual trust. However, understanding market conditions and assessing the property's value and potential risks are essential before entering into a sale-leaseback agreement. 19. Capital expenditures, CapEx. Capital expenditures, CapEx, are funds used to acquire, upgrade, or maintain commercial properties to enhance their value or extend their life. Examples include roof replacements, HVAC installations, and structural repairs. CapEx differs from operating expenses, which cover routine maintenance and day-to-day operations. Investors and property managers carefully plan CapEx budgets to ensure long-term profitability and avoid unexpected costs. Understanding CapEx is critical for assessing a property's true financial performance, as it impacts cash flow and overall returns. Well-planned CapEx investments can attract quality tenants and increase property value. 20. Escalation clause. An escalation clause in a lease agreement allows landlords to increase rental rates periodically, often tied to specific benchmarks like inflation or operating costs. Common in long-term leases, escalation clauses ensure landlords can offset rising expenses and maintain profitability. The clause typically defines the method of adjustment, such as a fixed percentage increase annually or alignment with the Consumer Price Index, CPI. For tenants, understanding escalation clauses is crucial to forecast future rental costs and budget accordingly. Transparent terms protect both parties from disputes and foster a sustainable landlord-tenant relationship. Thanks for watching the video. Please subscribe.